You've given us a comprehensive overview of what is happening in the US economy. What are the consequences likely to be for a country like India? While we are growing and we discuss some of the data as far as we are concerned, what are the spillover effects going to be?
It's a great question. So when the monetary policy is loose, the spillover effect is that the cost of capital in the rest of the world starts to come down. So if you are a steel manufacturer in India, if you are an oil refining company, a petrochemicals company in India, your revenues are effectively in dollars, and therefore you don't need to really hedge if you take a dollar loan. Your cost of capital comes down significantly. You can borrow at very low cost of capital. What also happens is that because you are having near zero cost of capital in the US, the flow into venture capital funds like high risk investments and private equity funds starts to go up. And that allows a very long gestation projects to get funded, very long gestation companies to get funded. When, on the other hand, your cost of capital in the US goes up as dramatically as it has done, the availability, so for example, already steel companies and fairly good quality steel companies are now saying that dollar bond or dollar funding is now almost not available. We've heard of advanced economy firms, double A rated, borrowing in double-digit interest rates in dollar terms. So the cost of capital for the whole world has already started to go up. So that's the first spillover effect. On the fiscal side, so if they have fiscal easing, so what that means is the US economy's demand remains resilient as it has been this year. It will not be the same next year when the fiscal deficit doesn't go up. But this year, it has supported the demand domestically in the US economy, and which means that their imports have been much more resilient than they would have been. If there is stronger wage growth, then economies like India, which are in the business of providing services or exporting services to the US, also benefit, right? So if the US wage growth remains high, the gap between Indian wages and the US wages expands. If job openings in the US or unfilled job openings remain elevated, then there's a lot more of skilled work that starts to come to India as well. So both of these, so the fiscal spillovers are generally positive for goods exporters like China, for services exporters like India. But the negative monetary spillovers, of course, are a drag for the rest of the world as well. So that's how I would see it. Now, next year, we could see a problem where the monetary conditions remain tight till the time that the US goes into recession, when, of course, the Fed will be forced to change its stance. But the likelihood of recession will mean that the risk appetite in financial markets goes down, and therefore the cost of capital goes up. And therefore, I think the markets will be very choppy next year, in my view.
If you like the video, do like, comment, share, and subscribe.